May 1984, Chicago, the seventh largest bank in the United States, is open for business on a Tuesday morning, and by Thursday it will be gone. Not closed, not merged, not quietly absorbed. Gone, in the way that only something enormous can disappear all at once, in full public view, with the whole financial world watching and nobody able to stop it. In 11 days, Continental Illinois National Bank and Trust will lose $10.8 billion in deposits. Customers are not lining up outside the doors because there are no lines. This is the first bank run in American history conducted entirely by telephone and wire transfer, a silent electronic stampede that moves faster than any crowd ever could. And when it is over, the United States government will do something it has never done before, something that will change the rules of American capitalism forever, quietly and without a vote, in a way that the country is still living with today. How does the largest bank rescue in American history happen with almost no public debate? And why are we still paying for that decision every single time a financial institution gets too large, too reckless, and too connected to be allowed to fail? This is the story of Continental Illinois. By the end, you will understand the doctrine that was born in that rescue. See the 7-step pattern that made it inevitable, and recognize exactly why the phrase "too big to fail" is not a description of a bank. It is a guarantee written in public money. This is not just history, this is a warning. It is the late 1970s, Chicago, Illinois, and the air smells like ambition. Continental Illinois is not the most famous bank in America, but among the people who matter, the corporate treasurers, the oil executives, the commercial lenders, it is the one everyone respects. It sits at 231 South LaSalle Street in a building that looks exactly like what power is supposed to look like, all granite and marble and the quiet confidence of an institution that has been here longer than most of the people doing business with it. And in this world, Continental is doing something no other bank in the country is doing quite as aggressively, quite as successfully, or quite as recklessly. The bank has made a decision about its future, and that decision has a name: wholesale banking. Continental is not interested in the small depositor, the family with a savings account, the mortgage customer who comes in on a Saturday morning. That is retail banking, and retail banking is slow and careful and boring. Continental wants the big fish. Corporate loans, industrial credit, energy financing, the deals that run into the hundreds of millions, where the customer is another institution rather than a person. And in the late 1970s, with inflation running hot and the American economy churning and the oil patch booming, this strategy is working beyond almost anyone's expectations. Continental is growing faster than its competitors. Its profits are climbing. Its loan portfolio is expanding so quickly that the bank's executives are celebrated in the financial press, profiled as the forward-thinking visionaries who figured out what banking could be in the modern era. But beneath this success, something is quietly wrong. Continental needs loans to grow, and to find enough loans to satisfy its appetite, it has started buying them from other banks. This is not unusual. Loan participations, where one bank originates a loan and sells portions of it to others, are a normal part of commercial banking. The problem is the source. Continental has developed a deep relationship with Penn Square Bank, a small institution in Oklahoma City that is operating out of what used to be a shopping mall. Penn Square is originating oil and gas loans at a furious pace, loans to wildcat drillers and energy speculators riding the boom, and Continental is buying them. By 1981, Continental holds more than $1 billion in Penn Square loan participations. Nobody at the senior levels of Continental seems to be asking very hard questions about the quality of what they are buying. The loans are performing, the energy sector is booming, the strategy is working. What could go wrong? Meet Roger Anderson. He is Continental's chairman through most of this period, a tall, quiet man with a reputation for caution that is becoming increasingly disconnected from the institution he is running. He believes in Continental's strategy with the particular conviction of someone who has watched it succeed for years. When subordinates raise concerns about the Penn Square relationship, about the concentration of energy loans, about the pace of growth, he has answers for all of it. The portfolio is diversified. The loans are sound. Continental is not some savings and loan-taking chances with depositors' Christmas club accounts. It is a sophisticated commercial bank with sophisticated risk management. He is not lying when he says these things. He genuinely believes them. That is the most important detail of all. Now meet Irvine Sprague. He is a regulator, a member of the Federal Deposit Insurance Corporation's board, and he has been watching the banking industry long enough to know that the phrases "this time is different" and "sophisticated risk management" often appear together in the months just before a disaster. He does not think Continental is going to collapse. Nobody serious thinks that. But he notices things. He notices how fast the loan book is growing. He notices the Penn Square concentration. He files the observations away the way careful people do, in the part of the mind that says, I hope I am wrong about this. He is not wrong. And then there is a third figure, though he has no name here because he represents dozens of men in similar positions across the country. He is a corporate treasurer at a large American company, and Continental holds a substantial portion of his firm's short-term deposits. He chose Continental because Continental is safe, it is large, it is prestigious, it is the kind of bank you choose when your job is to not lose the company's money. He sleeps fine at night, he has no reason not to. What none of these three people know yet is that everything is about to change, and when it does, it will change not just for Continental, but for everyone. July 5, 1982, Penn Square Bank fails. The Federal Deposit Insurance Corporation closes it on a Tuesday night. And when the financial press picks up the story the next morning, the details are almost comic in their brazenness. Penn Square had been making loans on the basis of fraudulent documents, inflated valuations, and in some cases the personal enthusiasm of a loan officer named Bill Patterson, who was known to close deals while wearing a Viking helmet and drinking amaretto from a cowboy boot. This is not sophisticated banking. This is not careful risk management. This is chaos dressed up in oil patch optimism, and Continental has been buying it by the billion. When the full scale of Continental's Penn Square exposure becomes clear, the bank's stock drops. Its loan losses start mounting, but the real damage takes time to accumulate, because the energy sector does not collapse all at once, and Continental is a large and complex institution with many other business lines to absorb the pain. For 18 months, the bank works through the problem. It writes down loans, it restructures positions, it tries to project confidence. The management that presided over the Penn Square relationship is gradually replaced. New leadership comes in with promises of tighter underwriting and more conservative growth targets. The bank is wounded, but it is still functioning, and the prevailing view in the financial community is that Continental will survive, diminished but alive. By early 1984, however, the loan losses keep coming. Continental is posting quarterly losses that would have been unthinkable 2 years earlier. Its credit rating is downgraded. And then in May of 1984, a story appears. It is a small item, a wire service report based on a rumor circulating in the market. And it says something that no one has officially confirmed. Continental Illinois may be insolvent. The rumor may not even be accurate, or at least not yet. But the people who hold Continental's deposits read it. And what happens next is the first true electronic bank run in American history. The mechanism matters here, because it is different from anything that came before. Continental's deposit base is almost entirely institutional. It is not retail depositors with $50,000 savings accounts. It is corporations, foreign banks, and government entities with deposits in the hundreds of millions, money held in instruments that can be moved with a phone call and a wire transfer. When these depositors start to worry, they do not form a line, they make calls to their banks and their brokers, and the instructions go out electronically, and within hours billions of dollars are moving. On May 8, Continental loses $1 billion in deposits, then $1.5 billion more, then more after that. By the time the Federal Reserve and the FDIC are fully focused on what is happening, the bank has lost $10.8 billion in 10 business days. No institution can survive that kind of withdrawal. No management team, no matter how talented, can plug a hole that large fast enough. Continental Illinois is dying. The speed of it is what paralyzes the regulators at first. Sheila Bair, who will later run the FDIC during the 2008 crisis, will describe this moment as the event that fundamentally changed how American regulators think about large bank failures. The traditional toolkit, close the bank on a Friday, find an acquirer over the weekend, reopen Monday morning under new ownership, simply does not work when the institution is this large. The FDIC can handle a community bank, it can handle a regional bank. There is no playbook for an institution with $40 billion in assets and creditors in 30 countries. Bill Isaac is the FDIC chairman in May 1984, and he is in an impossible position. He has, by law, two choices. He can liquidate Continental, pay out insured depositors up to the $100,000 limit, and let the uninsured depositors take their losses, or he can arrange a merger, finding some larger institution willing to absorb Continental's good assets while the government takes the bad ones. The problem with option 1 is that it would instantly wipe out billions of dollars held by large corporations and foreign institutions who kept their money at Continental because they believed large American banks were safe. The problem with option 2 is that nobody wants to buy Continental. The bank is too damaged. The loan book is too uncertain. Every institution that looks at the numbers decides the risk is too great. And so on July 26, 1984, the FDIC does something it has never done before. It does not let Continental fail. It does not arrange a merger. Instead, the government effectively buys the bank. The FDIC injects $4.5 billion of new capital, takes 80% ownership, removes the existing management, and guarantees not just the insured deposits, but every single depositor, every single creditor, every single counterparty. Not $1 of uninsured funds is lost. The institution that ran reckless loans through a shopping mall bank in Oklahoma City is rescued, whole and complete, at taxpayer expense. And in the hearing rooms of Congress, where the questioning is sharp and uncomfortable, a regulator says something that will echo for 40 years. He says, in effect, that Continental is too big to fail. The rescue works, in the narrow sense that Continental does not collapse, the financial system does not seize up, and the creditors of the 30 largest American banks do not spend the rest of 1984 in a panic. But what has actually happened here is more complicated than a successful intervention, and the people who understand it best are the most worried. Because the FDIC has just sent a message to every large financial institution in the United States. A message that no press release or congressional testimony can walk back. The message is this: if you are large enough, and connected enough, and your failure would be disruptive enough, the government will save you, not your depositors, you, the institution itself. The shareholders and the bondholders and the counterparties will all be made whole, because the alternative is considered too dangerous to contemplate. John Carrican, an economist at the Federal Reserve Bank of Minneapolis, says it almost immediately. He publishes a paper in late 1984 arguing that the Continental rescue has fundamentally distorted the incentive structure of American banking. When a bank knows it will be rescued if it gets large enough, it has every reason to get large enough, and every reason, once it gets there, to take risks that smaller institutions cannot afford to take. Carrican calls it deregulation without market discipline. You have told banks they can gamble, and if the gamble goes bad, the taxpayer covers the loss. This is not what the FDIC was designed to do. It is not what deposit insurance was designed to do. It is something new, and it is dangerous in ways that will take decades to fully understand. What actually happened at Continental was not primarily a story about bad loans, though the bad loans were real. It was a story about the way that wholesale funding transforms the risk profile of a large bank. Continental was not funded by stable retail deposits the way a traditional commercial bank is. It was funded by short-term institutional money, billions of dollars in overnight borrowings and certificates of deposit that could be pulled in hours if confidence wavered. This made Continental enormously vulnerable to exactly the kind of sudden confidence crisis that destroyed it. And this same funding model was spreading to other large banks. Because wholesale funding is cheap and flexible and allows for rapid growth, the lesson of Continental should have been, do not let large banks fund themselves this way, because when it goes wrong instantly and catastrophically. Instead, the lesson that spread through the industry was, if you get large enough, you will be rescued, so get large. Now look at what actually happened in the years after the rescue. The 7-step bubble pattern ran exactly according to form. The new paradigm was the deregulatory environment of the 1980s, a genuine belief among serious economists and policymakers that markets were self-correcting and that large institutions had sophisticated enough risk management to be trusted without intensive supervision. The easy money came from financial deregulation, which allowed banks to expand into new businesses, to grow their balance sheets, and to fund that growth with increasingly unstable short-term borrowing. The social proof came from the fact that every large institution was growing this way, and any bank that refused to participate was simply left behind. The complexity came from the proliferation of financial instruments, junk bonds, securitized loans, derivative contracts that made it genuinely difficult for regulators, and often for bank management itself, to understand the true risk profile of a large institution. The peak euphoria was the 1990s and early 2000s, when American financial institutions had grown to a scale that would have been unimaginable to the regulators who handled Continental in 1984. And the consensus view was that modern risk management had made financial crises a thing of the past. The trigger was the collapse of the subprime mortgage market in 2007, and the blame game began. Before the smoke had cleared, remember Roger Anderson, Continental's chairman, who believed in the strategy with the particular conviction of someone who had watched it succeed. By 1985, he has gone from Continental, replaced by government-installed management, his career effectively over. He lives out his later years in relative obscurity. He did not set out to destroy his bank. He set out to build something great, but he could not see the system he was inside, could not step back far enough to recognize that what looked like success from where he stood was actually the early stage of a failure that was simply taking longer to arrive than usual. That is the trap that catches almost everyone inside a bubble. The success is real, right up until the moment it is not. Now look at 2008, because the line from Continental to Lehman Brothers is not a metaphor, it is a direct, traceable chain of decisions, precedents, and incentives that flows from that July afternoon in 1984 when the FDIC decided the seventh largest bank in America was too important to let the market consume it. By 2008, too big to fail is no longer a phrase used in congressional testimony. It is a known feature of the financial landscape baked into the bond prices of large financial institutions which trade at lower interest rates than their actual risk would justify because the market assumes correctly that the government will stand behind them if they get into trouble. The implicit government guarantee is worth billions of dollars a year to the largest American banks, a subsidy that flows to their shareholders and their executives, and their bondholders paid for by smaller institutions that do not get the same treatment and by taxpayers who have never been asked to vote on the arrangement. Run through the checklist. New paradigm. In the mid-2000s, the new paradigm is the Great Moderation, a genuine and widely shared belief among economists and central bankers that modern monetary policy has tamed the business cycle, that the volatility of the past is behind us, that housing prices do not fall nationally because they never have before. Easy money. The Federal Reserve holds interest rates at 1% for most of 2003 and 2004, flooding the financial system with cheap capital that has to go somewhere, and what it finds is the mortgage market where it can be packaged into securities and sold to investors who desperately need yield. Social proof. By 2005, nearly a third of American homebuyers are taking out loans with no down payment, no income verification, and interest rates that will reset upward after 2 years. Your neighbor is flipping houses. Your brother-in-law just refinanced and pulled out equity to buy a boat. Complexity. Can you explain how a collateralized debt obligation squared actually works? The people buying them often cannot either, but the rating agencies say they are safe, and that is close enough. Peak euphoria. In 2006, the chief executive of Citigroup describes his bank's strategy by saying that, as long as the music is playing, you have to get up and dance. He is not being reckless, he is describing what it feels like from inside the system. The trigger arrives in February 2007 when HSBC discloses larger than expected losses on its American mortgage portfolio. It is a small crack, the market absorbs it, but the crack does not close. And over the next 18 months it spreads through the entire edifice of mortgage-backed securities, structured vehicles, and leveraged institutions that the financial system has spent a decade constructing. When Lehman Brothers files for bankruptcy on September 15, 2008, it is not because the government decided it was not too big to fail. It is more complicated than that, a decision made in hours under conditions of extreme uncertainty with inadequate information. But the aftermath makes clear that the principle established in 1984 has not gone away. Within days of Lehman's collapse, AIG is rescued with $85 billion. The commercial paper market freezes. The government authorizes the Troubled Asset Relief Program. One by one, the largest financial institutions in the country are backstopped, their counterparties protected, their creditors made whole. The system that was built on the assumption of too big to fail collapses, and is rebuilt on the same assumption. The Dodd-Frank Act of 2010 is a serious attempt to address this. It creates an orderly liquidation authority designed to allow regulators to wind down large failing institutions without triggering the kind of systemic panic that made the rescues of 2008 feel unavoidable. It requires large banks to hold more capital, to maintain living wills explaining how they would be resolved in a failure, to subject themselves to stress tests and enhanced oversight. These are meaningful reforms. The banking system in 2024 is genuinely more resilient than it was in 2007, and anyone who says otherwise is not engaging honestly with the data. But the 5 largest American banks today hold a greater share of total banking assets than they did before 2008. The implicit government guarantee is still priced into their bonds. The incentive to grow large enough to be rescued has not been eliminated. It has been acknowledged, partially addressed, and then allowed to persist because the alternative, a financial system in which large institutions genuinely face the possibility of failure and their creditors genuinely face the possibility of loss, is something that no government has yet been willing to fully accept. So why do we keep arriving at this same place? Why does every generation of regulators, despite knowing the full history of what came before, end up making the same implicit bargain with large financial institutions? The answer is not stupidity, and it is not corruption, though both have played their roles at various moments. The answer is something more fundamental to the way human beings manage risk, when the consequences to the worst outcome are genuinely catastrophic. When a regulator faces a choice between letting a large bank fail and accepting all the unknowable systemic consequences that might follow, or rescuing the bank and accepting a known cost and a distorted future incentive, the regulator almost always chooses rescue, not because rescue is optimal, because rescue is survivable. Letting the bank fail might work out fine, or it might trigger a cascade that destroys the savings of millions of people and throws the economy into a depression. The rescue is expensive and morally compromising, but at least you know what you are getting. This is not a unique feature of financial regulation. It is a feature of human decision-making under conditions of radical uncertainty. We choose the known bad outcome over the unknown terrible one, and we rationalize it afterward as wisdom rather than fear. Every regulator who participated in the Continental rescue believed, probably correctly, that letting the bank fail would have caused serious damage to the financial system. Every regulator who participated in the 2008 rescues believed, probably correctly, that the alternatives in the moment were genuinely worse than the bailouts. And both sets of regulators were aware, even as they acted, that they were making the problem of too big to fail worse for the next generation of regulators. They did it anyway, because they had no choice. Because the system they were operating inside had been constructed, over decades of accumulated decisions, in a way that made the rescue feel like the only available option. This is what the story of Continental Illinois actually teaches. Not that regulators are cowards or that bankers are criminals, though some of both have been true at various moments. Not that capitalism is a fraud or that markets cannot be trusted. The story teaches that incentive structures are more powerful than intentions, that the rules of a system matter more than the character of the people operating inside it, and that once you have made a promise, even implicitly, even accidentally, even as a one-time emergency measure, you have changed the landscape for everyone who comes after you. The FDIC did not intend to create the doctrine of too big to fail in 1984. It intended to prevent a financial panic, but the effect of its action was to announce, permanently and irreversibly, that the largest American financial institutions operate under different rules than everyone else. The crash is never the real disaster. The disaster is the rule change that follows it, the accommodation that gets built into the architecture of the system and stays there long after the crisis is forgotten. What should you watch for right now? Watch for large financial institutions growing their balance sheets faster than their earnings can justify. Watch for funding structures that depend on short-term confidence rather than long-term deposits. Watch for regulatory conversations that focus on managing the consequences of failure rather than reducing the probability of it. And watch for the language. When someone with authority starts describing a financial institution as systemically important, they are not giving you a description. They are giving you a promise, and you are the one who will pay for it. Understanding this does not give you a way to profit from it or a way to prevent it. But it gives you something that is genuinely useful. The ability to recognize what is happening when it is happening, to see the implicit guarantee for what it is, to understand that the stability of the largest financial institutions in a given country is not a market outcome but a policy choice, and to ask when the next crisis comes, which is not a question of whether but of when, whose interests are actually being protected by the rescue. That question was not asked clearly enough in 1984. It was not asked clearly enough in 2008. It will be asked again. And the answer will be the same, unless the people asking it have enough history to recognize the pattern before the deal is already done. The real lesson here is not about banking. It is about what happens when any institution or person or entity gets large enough and connected enough that the consequences of their failure become everyone else's problem. We have built a world full of such entities, in finance and in technology and in agriculture and in infrastructure, and we have made the same implicit bargain with all of them. We have said, without saying it out loud, that their failure is not something the market is allowed to process. And every time we make that bargain, we shift a little more risk from the institution to the public. And we shift a little more power from the people who hold the institution accountable to the institution itself. This is the actual legacy of Continental Illinois, not a bank that failed, but a principle that survived the failure, spread to every corner of the financial system, and is still doing its quiet work today, in every bond price, every regulatory decision, Every conversation about what the government would or would not let happen if the wrong institution got into trouble at the wrong time. Now I want to hear what you think. What institution today do you believe is operating under an implicit too big to fail guarantee? And what would it actually take to eliminate that guarantee without triggering the very crisis the guarantee is designed to prevent? That tension is real, and I do not have a clean answer to it. Drop your thinking in the comments, because the most interesting analysis of this problem I have ever encountered has come from people who are not economists, who are just paying careful attention to the world around them and asking the right questions. If this changed how you see the architecture of the financial system, hit the like button and subscribe. Next time, we are looking at another moment when a government decision, made quietly and in crisis, rewrote the rules of the economy in ways that are still playing out right now. History does not repeat, but it rhymes. And right now it is rhyming loud. See you in the next one.